Welcome back to the Quantum Chain podcast. Today, we're diving into something really fundamental in the digital asset space right now, stablecoins.
Yep, absolutely key.
We've got this stack of sources you sent in articles, research, even some official statements, and our mission is to, well, cut through it all.
Right, to figure out what you actually need to know about them.
Exactly. So these are cryptocurrencies, but they're built differently, aren't they, with a specific goal?
That's the core thing, stability. Unlike Bitcoin or Ether, they aim to hold a steady value. Usually it's pegged to something familiar, like the US dollar.
And they've become so important for, well, tons of reasons. Trading, decentralized finance, maybe even helping people without bank accounts.
For sure. So today we'll unpack what they are, the different ways they try to stay stable, why they matter so much, what regulators are thinking, especially this interesting view from an SEC division, and importantly, the risks, because there are definitely risks.
Yeah, we need to talk about those. We'll get into the mechanics, the uses, the regulation stuff, and maybe some surprising details hiding in these sources. Let's get started.
Okay.
So let's start super basic. What's a stablecoin designed to do?
Well, think of it like this. It's trying to be a digital version of stable traditional money. It's crypto, but it's pegged, linked to a reference asset, mostly the US dollar, but sometimes other currencies or gold, or even a mix of things.
And the whole point is avoiding those wild price swings you see elsewhere in crypto, right?
Exactly, to make it useful for, actually buying stuff or just holding value without worrying it'll crash overnight.
The design is usually one-to-one, isn't it? Like one coin equals $1.
That's a typical goal, yeah, 1 for 1.
But, and this seems crucial from the sources, that stable name, it's more like an ambition sometimes. There's no absolute promise it'll always stay pegged.
That's a really important caveat, absolutely. The design aims for it, but markets are markets. And a big question is always, are the assets backing it really there and sufficient? That gets scrutinized a lot.
Right, design versus reality. So, okay, if stability is the goal, how did they actually try to achieve it? This seems to be where the different flavors come in.
Correct. The main approach is collateralization, meaning they're backed by some kind of reserve assets.
And the most common type seems to be the fiat-backed ones.
Oh, definitely, by far. These are pegged to a specific currency, USD, Euro, whatever, and the idea is they're backed one-to-one by actual reserves of that currency, held by the issuer, usually some kind of financial company.
How does that work, like mechanically?
So the issuer takes your dollars, puts them in reserve, and mints you the equivalent stablecoins. Then you should be able to redeem those stablecoins back for your dollars. The key is that the value of the reserves should always be equal to or more than the value of the stablecoins out there.
And these are names people probably know, right? Tether, USDC.
Yep. Tether, USDT, USD Coin, USDC, True USD, Gemini Dollar, Paxos USD, FDUSD. There are quite a few. And new ones pop up too, like Ripple's RLUSD, which they're positioning as more for institutions, talking about segregated accounts and bankruptcy protection for the reserves.
Tether is interesting, though. It's huge, one of the oldest, but the sources mention some controversy around its backing historically.
Right. USDT launched way back in 2014. It's incredibly liquid, used everywhere for trading. But yeah, it's faced a lot of questions over the years about whether its reserves were fully backed, especially with actual cash dollars. The sources note they were fined by the CFTC for misleading statements about their reserves between 2016 and 2018, apparently. Only about 27.6% was backed by fiat then.
Wow, only 27.6%.
According to that finding, yeah. The issue reports now, but, some skepticism lingers in parts of the market. It highlights how crucial transparency and trust are for these fiat-backed coins. Ripple, with RLUSD, seem to be trying to address that directly by emphasizing the structure of their reserves.
So trust in the issuer is huge for fiat-backed. What else is there? Commodity-backed.
Yeah, that's another type. Pegged to commodities like gold, silver, maybe even oil or treasuries. Think Panx Gold or Tether Gold.
Yeah.
Sometimes you can actually redeem the coin for the physical commodity.
Huh. So you could get gold exposure without needing a safe?
Pretty much, yeah. That's the appeal. Avoid storage hassles. But the flip side is the issuer does have those costs storing and securing the physical stuff. That's a risk factor.
Okay. And then crypto-backed. Now this one sounds a bit weird. Using volatile crypto to back something stable?
It does sound counterintuitive, yeah. But the mechanism is different. These are backed by other cryptocurrencies, but it's all managed on-chain with smart contracts. And the key concept is over-collateralization.
Over-collateralization meaning?
Meaning you have to lock up more value in crypto collateral than the value of the stablecoin you want to mint. So maybe you lock up $1.50 or $2 worth of Ether to get $1 worth of the stablecoin.
Ah, so there's a buffer. If the collateral price drops a bit, the stablecoin peg is still protected.
That's the idea, exactly. That cushion absorbs volatility. The supply adjusts automatically based on rules in the smart contract, often with other tokens or incentives helping keep the price stable. Maker DAI is the classic example backed by Ether and other cryptos and these things called collateralized debt positions or CDPs. Wrapped Bitcoin, WBTC is another one, kind of, representing Bitcoin on Ethereum.
What are the downsides there? Still sounds risky.
It is. The collateral is still volatile, so a really sharp crash could still break the peg, even with the buffer. Plus, you're relying heavily on the tech, the smart contracts working perfectly, the blockchain network itself not getting congested. One source mentioned a Maker DAO issue in 2020, linked partly to network congestion. And critically, if the collateral itself has problems, that affects the stablecoin.
Right, like if the crypto asset used as collateral suddenly tanks or gets frozen.
Exactly. We saw that ripple effect in March 2023. USDC, which is often used as collateral in DeFi, briefly lost its peg because of exposure to Silicon Valley Bank failing. And because DAI used USDC as collateral, DAI wobbled too. Shows how interconnected it all is.
Definitely. Okay, so that covers collateralized types. What about the ones without direct backing, the algorithmic ones?
Right, non-collateralized or algorithmic stablecoins. These are conceptually quite different. They try to maintain their peg using algorithms and smart contracts to automatically adjust the supply based on demand. No specific reserves needed to mint them.
Like a robot central bank?
Sort of, yeah.
Yeah.
If the price goes above $1, the algorithm increases supply to push it down. If it goes below $1, it reduces supply to push it up. Often there's a secondary token involved that traders can use to arbitrage and help stabilize price.
Examples?
Ampleforth is one that uses this rebasing idea to adjust supply directly in wallets. Basis was another, but it's gone now. But the name everyone remembers usually with a shudder is Taro USD. USD.
Ah, yes. That didn't end well.
Not at all. UST was huge, a top algorithmic stablecoin. It relied on this mechanism linked to its sister token, LENA. Then in May 2022, it just collapsed. Catastrophic.
The sources really emphasize how bad that was.
Yeah, it was brutal. UST completely lost its peg. LUNA went to basically zero. The estimate is nearly $45 billion in value wiped out in something like a week. It's the prime example of the massive risk with these purely algorithmic systems. If the mechanism fails under pressure, the whole thing can implode.
Yeah.
And Tron's USDD had issues too, losing its peg briefly after that.
Wow. Okay. A very stark reminder that stable is the goal, not always the reality, especially with algorithms. The mechanisms clearly matter a lot. All right, let's maybe take a quick pause there. We've covered the what and the how of stablecoins, the different types and mechanisms. When we come back, we'll dive into why they're so important and explore the growing regulatory landscape. Stick with us.
Musical break.
Baby, how you feeling? Head talk, check my nails. Baby, how you feeling? Feeling good as hell. Baby, how you feeling? Woo, girl, need to kick off your shoes. Gotta take a deep breath, time to focus on you. All the big fights, long nights that you've been through. I got a bottle of tequila I've been saving for you.
Thank God. 'Cause he better know my worth. There's so much that I deserve, but I ain't worried now. I'ma let my head down. He been trying it, but not today. So girl, if he don't love you anymore,
Walk your fine ass out the door. I'll do your head talk, check my nails. Baby, how you feeling? Head talk, check my nails. Baby, how you feeling? Shout out tonight. Head talk, check my nails. Baby, how you feeling? And we gon' be on head talk.
Welcome back to the Quantum Chain podcast. We were just unpacking the different kinds of stablecoins. Now let's talk about why they've become such a big deal. Why are they so important?
Well, they're often described as this crucial bridge, connecting traditional finance with the world of crypto and decentralized finance, or DeFi. They give people and businesses a way to interact with digital assets using something that feels familiar and, crucially, holds its value relatively steadily day to day. Unlike Bitcoin, which can jump or drop significantly in hours.
And they're vital for trading, right? Especially on crypto-only exchanges.
Absolutely critical. If an exchange doesn't let you trade directly with dollars or euros, stablecoins are how you move between volatile assets like Bitcoin or Ether without fully cashing out. It saves time, saves fees. They're also fundamental in crypto derivatives markets for things like margin and settling contracts.
And DeFi. It sounds like DeFi almost runs on stablecoins.
To a huge extent, yes. They are the bedrock for so much in DeFi. Lending platforms, borrowing, providing liquidity to decentralized exchanges, using them as collateral for loans. Stablecoins provide that stable unit of account that these activities need. Their growth is directly tied to the explosion in DeFi's total value locked, or TVL.
Beyond the crypto native stuff, what about real-world uses? Payments.
That's a massive area of potential, and actual use too. Stablecoins allow for sending money across borders quickly and cheaply. Think remittances, sending money home. Traditional services can be slow and expensive. Stablecoins offer an alternative.
Especially useful in countries with unstable local currencies, I imagine.
Exactly. They can offer a more stable way to store value or make payments digitally if your national currency is fluctuating wildly.
The sources also mention financial inclusion.
Right. For the billions of people globally who don't have access to traditional banking, stablecoins could potentially offer a way in. If you have a smartphone and internet, you might be able to access basic financial services, send and receive value peer-to-peer.
Are big institutions using them too?
Increasingly, yes. We're seeing use cases emerge for things like managing corporate treasury funds, settling large payments between businesses, even for settling trades of tokenized real-world assets like stocks or bonds represented on a blockchain. Their efficiency is appealing.
And just generally, they're the main way people get money into and out of the crypto ecosystem.
Yeah, they're the primary on-ramps and off-ramps. Converting dollars to a stablecoin is often the first step into crypto, and converting back is how you take profits or exit positions. Super important function.
Okay, so they have all these uses, bridging traditional and digital finance, which inevitably means regulators are paying close attention.
Very close attention. Globally, their sheer growth and potential impact on the financial system mean regulators everywhere are trying to figure out how to oversee them, to ensure stability, protect users, stop illicit finance.
What are the different approaches we're seeing? Let's start with the U.S.
Well, in the U.S., it's complicated because multiple agencies are involved: the SEC, CFTC, Treasury, bank regulators like the OCC. They're looking at fundamental questions. Are stablecoins securities? Are they commodities? How do they fit into the payment system? Could they pose systemic risks if they get really big?
Is there specific legislation being considered?
There have been proposals, yeah. Like a Stablecoin Transparency Act, which would basically require issuers to hold 1.1 reserves, actual cash or cash equivalents, and undergo regular audits. But nothing comprehensive has passed yet.
What about Europe? MiCA seems like a big deal there.
MiCA, the Markets in Crypto Assets Regulation, is definitely significant. It sets up a whole framework for crypto, including stablecoins. For stablecoin issuers, especially large ones, it imposes strict rules on reserves, transparency, governance, and requires them to be licensed, effectively limiting large-scale issuance to banks or regulated e-money institutions.
So quite a different approach, more focused on regulating the issuer type. And Asia.
It's varied. Japan actually passed laws recognizing stablecoins as a form of digital money, but again requires issuers to be regulated entities like banks or trust companies. Singapore's regulator, MAS, is proposing tough rules on reserves and risk management. Hong Kong is trying to attract crypto business by setting up clear rules. So different paths, but the trend everywhere is toward more oversight.
Okay, this global regulatory picture leads us to something specific in one of your sources, this statement from the SEC's Division of Corporation Finance. It sounds like they offered some clarity, but maybe only on a very specific type of stablecoin.
That's exactly right. It's a really important piece of nuance. The division put out a statement outlining its view on what they called covered stablecoins.
Covered stablecoins, how did they define that?
Very precisely. It has to be pegged 1-to-1 to the U.S. dollar, redeemable 1-to-1 for U.S. dollars, backed by a reserve composed only of U.S. dollars, government securities, or specific low-risk liquid assets like money market funds. Importantly, not other crypto, not commodities.
Okay, so the backing is key. What else?
The reserve's value must always equal or exceed the value of the stablecoins in circulation. And critically, how it's marketed matters. It must be marketed solely as a tool for commerce, payments, transmitting money, or storing value, explicitly not as an investment.
So, very specific criteria on reserves and marketing, purely utility-focused.
Exactly. And if a stablecoin meets all those specific criteria, the division's view, as stated, is that the offer and sale of that specific type of stablecoin doesn't constitute the offer and sale of a security under the main U.S. securities laws.
Which would mean, for that type only, the issuer wouldn't necessarily need to register those transactions with the SEC under those laws.
That's the implication of the division's view, yes. They walk through the standard legal tests, the Reeves test for notes, the Howey test for investment contracts, and concluded that for a stablecoin fitting their narrow-covered description, it doesn't look like a security.
Why not? Because the user isn't expecting profit from the issuer.
That's the core reasoning. The motivation for buying or using it isn't investment profit derived from the efforts of the issuer. It's to use it like a digital dollar for payments or holding value. It's presented as a commercial or consumer product, not an investment opportunity. The reserve, in this view, is a risk-mitigating feature, not part of an investment scheme promising returns.
Okay, but the source seemed full of warnings about this view.
Crucial caveats, absolutely essential to understand. First, this is just the division's view. It's not a formal rule or a statement from the full SEC Commission. It has no binding legal force.
So it's just guidance, not law.
Pretty much. And a court could disagree. Also, whether any specific stablecoin qualifies depends entirely on its unique facts and circumstances. This view only applies if a stablecoin perfectly matches every single detail of that covered stablecoin description.
Meaning it doesn't apply to algorithmic ones or ones pegged to euros or gold?
Correct. Or anything offering yield or interest. If a stablecoin's reserves include riskier assets, or if the reserves aren't properly segregated and only used for redemption, like if the issuer uses them for operations or lending, this view doesn't apply.
And the marketing part is strict too.
Very. The source details that the marketing has to emphasize utility speed, cost, stability, like a digital dollar. It cannot suggest profit potential, ownership in the issuer, or returns based on the issuer's performance. Any deviation, and the division's view might not hold.
That is incredibly specific. It gives a glimpse into how part of the SEC might view a very vanilla, utility-focused stablecoin, but it leaves almost everything else still uncertain.
Exactly. It's a narrow, safe harbor suggestion, not a broad regulatory solution. Which brings us back to the other risks that exist across the stablecoin landscape, even beyond that specific SEC view or algorithmic failures.
Like transparency issues we touched on Tether earlier.
Yeah, the lack of full, clear, audited proof of reserves has been a recurring criticism for some major players. While some issuers provide attestations, questions about the quality and sufficiency of backing can persist, creating uncertainty for users.
And counterparty risk seems huge, especially with centralized issuers.
Definitely. You're trusting the issuer to hold those reserves safely and to actually give you your dollar back when you want to redeem. What if the issuer goes bankrupt or just can't meet redemption requests during a crisis? That's a major risk. You might not get your money back.
And the fact that many big ones are centralized means they aren't like Bitcoin, totally decentralized.
Right. Transactions might not be truly permissionless. We've seen instances where centralized issuers have frozen funds on their stablecoin network, often due to legal requirements. That's a control point that doesn't exist in fully decentralized systems.
We talk about Terra's algorithmic collapse, but collateralized coins can fail too, right? Not just algorithm issues.
Absolutely. Smart contract bugs can be exploited. The underlying collateral itself can have issues, as we saw with USDC's brief depeg to bank exposure, which then impacted DAI. Systemic risk isn't limited to just one type. Flaws or external shocks can hit any of them.
And for all the DeFi stuff built on stablecoins, the regulatory picture is still murky.
Very much so for decentralized applications.
Yeah.
How do you regulate a protocol with no central operator? That uncertainty hangs over the DeFi space, the risk of future rules being restrictive.
And even with over-collateralization for crypto-backed ones, extreme market moves are still a threat.
Yes. A big enough, fast enough crash in the collateral's price could overwhelm the buffers and force liquidations that destabilize the peg. Or, as mentioned, if a key collateral asset itself becomes unstable or unusable, it undermines the stablecoin it backs.
And finally, some projects just don't make it.
Yeah. The sources list examples like Basis, which shut down due to regulatory concerns before launch, RLUSD, which obviously collapsed, and Diem, the project formerly known as Libra, backed by Facebook Meta, which was eventually abandoned after facing intense regulatory pushback. It's a tough space to succeed in.
Before we wrap up, one source mentioned an S&P Global report that actually tried to rate stablecoins.
Yeah, Kraken's article summarized that. S&P looked at things like reserve quality, how easily you can redeem them, the legal setup, governance, basically the risk factors.
What did they find? Any surprises?
Well, based on Kraken's summary, they rated USDC, Gemini Dollar, and Pax Dollar as strong. DAI, FDUSD and Tether came out as constrained, and Frax and TrueUSD were rated weak.
Interesting. It kind of reflects the different structures and controversies we've discussed. Shows not all stablecoins are created equal in the eyes of risk assessors.
Exactly. It highlights that spectrum of risk depending on the specific design and operation.
Okay, this has been a really comprehensive deep dive. We've gone from the basic definition of stablecoins aiming for stability against assets like the dollar through all of the different ways they try to achieve that.
Right, from fiat reserves, commodities, crypto over-collateralization, to those risky algorithms.
We've seen how vital they've become for everything from crypto trading and DeFi infrastructure to potential uses in global payments and financial inclusion.
And we tackled the regulatory maze, the increasing global scrutiny, different regional approaches like MiCA in the EU, and that very specific narrow view from the SEC division on covered stablecoins.
And crucially, we didn't shy away from the risks, transparency concerns, counterparty risk with issuers, centralization issues, the potential for depegging even in collateralized coins, and the outright failures we've witnessed.
I think the big takeaway is clear. Stablecoins offer huge potential and fill a real need. But stability is an aim, not always a guarantee. The methods vary hugely in risk. And the regulatory environment is still playing catch-up, trying to define things like that narrow, covered stablecoin category, which doesn't capture much of the market.
Which leaves us, and you, our listener, with a final thought. Given everything we've discussed, the different stability mechanisms, the varying levels of transparency, the regulatory uncertainties, the historical failures, how would you go about assessing if you can trust a particular stablecoin for something you need it for? Out of everything we've covered, what stands out to you as the most critical factor to consider?
Definitely something to mull over as this space continues to evolve. You can find more resources and discussion on our website, thequantumchainpodcast.com.
Thank you for listening to the Quantum Chain Podcast.
Live in desire, no one can take your goal.